makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Investors welcome cooler than expected inflation readings in the U.S. and the U.K. as evidence central banks may be done with aggressive rate hikes. While stocks rise, the dollar and pound fall. Siemens Energy sees a return to profit in 2024 after government intervention, but Alstom tumbles after the train maker said it's cutting jobs and selling assets to shore up balance sheets. Plus, China's President Xi arrives in the U.S. ahead of high-stakes talks with President Biden, while back home, Beijing pumps more cash into the banking system. So first thing is first, let's take a look at what the markets are telling us. This is the European markets map. The figure, or the one thing that we need to watch out for is, of course, dollar, what it's done so far. But it's very clear that we're not only getting the, I guess, not fallout, but the continuation of some of the stock rally that we saw because of the rate relief wager that the Fed is pretty much done hiking. The pound, though, slipping after that UK inflation slowed more than economists had forecast, a similar outcome to Tuesday's readings of U.S. prices. So let's get back to inflation. Again, UK inflation down to the lowest level in 2 years, bringing relief to consumers. Year-on-year CPI rising 4.6% in October, the lowest pace in 2 years. Now, this comes as a U.S. inflation print also showed a broad slowing yesterday, investors speculating that the Fed is done with its aggressive rate hiking cycle. Well, here with us, Skylar Montgomery Koning, head of macro strategy at TS Lombard. Skylar, thank you for joining us. When you look at that inflation print in the U.S., we also spoke to Jamie Dimon of JP Morgan, and he says, look, not that quickly. It's very difficult to see inflation, or he's not as optimistic that inflation will continue going down from now. What's your take on U.S. inflation?
Yeah, I mean, for the U.S., we are seeing disinflation, certainly. So headline inflation peaked all the way back in last summer and core a few months later. And since then, there has been this clear downtrend. You know, base effects are less favorable at some points. I think that's well understood by consensus. We also know that when inflation is higher, it's more volatile. And you can see that clearly in the impact in geopolitics, right? As commodity prices go up and down, and that feeds into headline inflation automatically and core through the impact it has on it. So we will get inflation prints that are a bit hot, and core definitely is still too elevated for the Fed's comfort, but the trend is still in the right direction. And I think that's the key for the market, and that's what we saw yesterday. So we think this disinflation story has legs into the end of the year, and that markets can look through small upside surprises when they do come.
Okay, so Skylar, I was telling you about JP Morgan Chief Executive Jamie Dimon. Here he is.
They're doing the right thing to pause for now. You know, they've raised rates a lot, you know, to wait to see the effect on the economy in the U.S., particularly as the fiscal spending, the excess fiscal spending is winding down and quantitative tightening is kicking in. But I still think, you know, you should prepare. They might have to do a little bit more. And I think people should be prepared for that, just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
Okay. And well, also 3 months ago, Fitch Ratings downgraded U.S. credit rating. And this weekend, we saw Moodys changing its outlook on the U.S. credit rating to negative, pointing to a sharp rise in debt servicing costs and political polarization. What do you expect in these terms? You know,
I find it a little ironic that Fitch and Moodys are doing that today. Mm-hmm. So here's what I think. They are right to point out those issues. I would take polarization off. That's always been true in a democracy. But yes, we have far more debt and more debt financing. We've been a little profligate when it comes to that. But the market is pricing us as AAA, which I think is more right, and the market will be more right than the rating agencies. I also want to point out, I find this almost funny, they have a lot of countries rated AAA. They all live under the protection of the American military. And so I think it's a little peculiar that that makes them AAA, but not America. So America will be fine, but we got to get our hands around these problems. They will not age well. The deficit's a lot bigger this year than we thought. There may be consequences of that. And so I think they're right to point it out.
Well, that was the JP Morgan Chief Executive Officer, Jamie Dimon, speaking exclusively with our affiliate El Financiero, Bloomberg in Mexico. So let's also bring in Eddie van der Walt from our Bloomberg Markets live team. Eddie, when you look at Fed swaps, they're definitely indicating the odds for another hike have fallen to almost zero. The market actually pricing in now a 50 basis point rate hike by July, rate cut by July. Are we actually crying victory before we're really seeing the whites of inflation going down?
You know what, Francine, I looked at those numbers yesterday. Inflation came in 10 basis points below expectations, right? Core came in just below expectations. And the market reaction was huge. I think what was happening was that two things simultaneously. As you point out, the odds of a rate hike has completely disappeared. The market is just not expecting a hike. At the same time, at the margin, some people added to the expectations of a rate cut next year or more rate cuts next year. So you had this pricing out of the hike and a small pricing in of some cuts, and that just amplified the downside moves in yields, and so we saw. I think it's not a normal distribution of moves that we saw. It's almost a log normal distribution that you saw, and it very heavily skewed the market's reaction. But I think what happened yesterday is we're probably much more headed towards a soft landing type of outcome. But very interesting to see just how much the market moved on those moves.
Skylar, give me a sense of how you build, and you're looking at all asset classes. So how do you build an ideal portfolio? Like how much commodities versus, equity or fixed income?
Yeah, I mean, I'll say right now that we very much view macro fundamentals as being solid, right? So the disinflation trend, as I said, should continue into 2024. Data surprises in the U.S. are strongly positive. A soft landing looks increasingly likely, and you look to be finding more of a floor in Europe and China, as well as if you look to central banks, they're clearly heading for the pause stage. They're waiting for inflation to come through and for that tightening to feed into the economy. So for us, that means that we're relatively risk positive. I think the other big thing to highlight is the divergence in growth between U.S. and Europe. So for us, we think this U.S. exceptionalism will continue into next year. So while we're more positive on risk, we are more positive on U.S. than European risk. I think the other thing to highlight is that with yields, at current levels, that is a good risk reward in terms of the income is quite good as you head into next year. And especially at the front end, where the Fed has somewhat limited how high you can go in yields on the front end, certainly, there's good risk reward there. And so I think actually it's a pretty good investing environment overall.
So Skylar, are there points where you actually want to enter the market, or again, is it a little bit of a wait and see? Because it does also seem quite bifurcating, all about inflation.
Yeah, absolutely. I mean, so we've obviously had a big move yesterday. You've seen kind of overreactions, especially, I think, when you look to FX. The dollar moved strongly, and I think that's largely a reflection of positioning being very overbought dollars. In equities as well, we've seen a large move. And so potentially you want to look for opportunities to buy those dips. But I think especially heading into 2024, people are unsure about, in the same way heading into 2023, people thought there was going to be a recession and then it never occurred. Right now, we're unsure of whether or not there's going to be a recession in 2024. And that leaves some room to rally into the end of the year. And so I think a lot of people are thinking that they don't want to miss that rally, especially if they've got cash sitting on the side.
Eddie, what else are you watching? We know that the meeting between Presidents Xi and Biden are extremely important to see whether some of, the very tense relationship, whether that thaws away. Could potentially that be a market moving event?
Yeah, I think Skylar is exactly right. I think the market right now, I think a lot of traders will be thinking about positioning into year end and then positioning into next year. And I think, that China-US relationship that you're alluding to, that becomes more and more important as we move into 2024, as we get closer to that US election. I think, next year is going to be a big political year. We're going to have the US, we're going to have the UK, elections likely. And I think that's probably going to define market trading a lot, because you are going to talk about the geopolitics, you are going to talk about different things, but at the same time Skylar also mentioned, the short end of the curve. I think the degree of steepening and just where that steepening comes from in the yield curve, I think those are the two main themes for me. And I think there is probably much more steepening to come, because at some point, if this market is pricing not a U.S. recession next year, if the market is saying, it's possible, but it's no longer likely, then you're going to have to see longer end yields, pushing above and disinverting the curve a little bit more.
Thank you both, of course, for joining us. Eddie van der Walt, of course, from Bloomberg MLive team. Skylar Montgomery Koning, head of macro strategy at TS Lombard, stays with us. Now, we're also getting some breaking news. Germany's top court has struck down a key element of the government's funding plans to address climate change and transform the economy. So at the moment, this just broke seconds ago. The challenge was filed by lawmakers from the main opposition Conservative Alliance, who said they wanted to ensure that the sustainability of the country's public finance continues. So for the moment, the Federal Constitutional Court has ruled that the shifting of the 60 billion euros earmarked to tackle the pandemic into a one-off budget fund violated German constitutional law. I don't think it's the only challenge that we'll see out there in some of the funds that then have been transferred to other parts of the economy. An extremely important ruling from Germany's top court. You can see euro dollar 108.63. Coming up, another cash injection for China's banking sector, but better than expected retail sales also give the economy a boost. We'll have a full roundup of that next, and this is Bloomberg.
The United States imports circa $500 billion of goods from China a year. Our economies are incredibly coupled together, and an abrupt decoupling would come at just catastrophic costs to the people of both countries.
Well, that was the Citadel Chief Executive Officer Ken Griffin speaking exclusively to Bloomberg at the Citadel Securities Global Macro Conference in Miami. That interview done by Arshonali Bazak. Now, China has stepped up its efforts for its economy by pumping the most cash into the banking system since 2016. We've also had consumer spending data out of China, which show retail sales rose some 7.6% in October compared with a year ago. Let's bring in Bloomberg's Jill Desis in Hong Kong. Jill, great to have you on the program today. Now, another cash injection was on the cards, but this is actually bigger than expected.
Yes, Francine, it really is. I think that at this point, what you're seeing happen with the People's Bank of China here is that they're offering more liquidity. They're trying to help the banking system a bit. We actually think this is about equivalent to a decently sized cut to the reserve requirement ratios, the amount of cash that banks have to keep in reserve. And so what this should ultimately do from a monetary policy perspective is actually help the PBOC, avoid trying to, trim rates, at least within the next couple of months. That should help them continue to support the economy from a monetary policy side in some respect without cutting rates, which can actually weigh on profit margins for banks if they cut a bit too deeply. So I think that that's why you're seeing this larger than expected net injection today.
But at the same time, Jill, I guess retail spending was stronger than expected. That's the flip side.
Yes. So the data today, the economic data today that we got out of China was pretty interesting. You did see that bigger than expected jump in retail sales, 7.6% year on year. The thing that I want to caution with that data, though, Francine, is that it does compare to a pretty low base from October 2022. Remember, that was when China was still observing quite a lot of pandemic-related restrictions, lockdowns, and there was also rising COVID outbreaks in the country. And so the thing that we have to be really careful about when it comes to this economic data today is that even if those numbers are pretty strong, the base of comparison is so favorable this year. I do want to point to some mixed data elsewhere within the set that we received today. You look at fixed asset investment, for example, which actually came in a bit under what we thought it was going to. That's in large part due to this pullback even more in property development investment that was, I think, decelerated more than we expected. So some positive signs there for the economy, but there's still a lot of work to go when it comes to China.
Jill, as always, thank you so much for a great analysis and roundup of the main news out of China, our Jill Decis. Now, let's get back to Skylar Montgomery Koning, head of macro strategist at TS Lombard. Skylar, I don't know, again, we were talking actually about whether the fact that President Xi and President Biden are meeting could be market moving, but certainly as long as things don't escalate, that's a positive for the economy and therefore markets.
Yeah, absolutely. I mean, I think because tensions had gotten so high, there was quite a lot priced in negatively. For China in particular, what you've seen is, we actually reopened a year ago, if not more, and people got excited more than a year ago over Chinese stimulus feeding into asset prices and feeding into the economy strongly. And we're still getting this kind of drip feed in stimulus that's not actually making a huge impact because we're not doing the same kind of supersized stimulus and infrastructure-driven stimulus. It's consumer-driven stimulus. So it's a very different environment than the rebounds we've seen previously. And so it's in China's interest now as well to have better relations with the U.S. because they need that bottoming in data, which will likely come through this quarter. But for them, it's also in their interest to have a more positive relationship with the U.S. and to see that feed into markets as well as into their growth outlook.
Skylar, is there something else actually that you look in terms of, if you look at the macroeconomic trends we've touched on, you look at fundamental analysis, but what have you seen in earnings that could be a little bit off because of everything else that's going on?
Yeah, I mean, the U.S. earnings season was actually quite strong. For us, corporate fundamentals, they look to be bottoming. We had 3 quarters of negative earnings, and we're now out of the earnings recession. So since 2021, margins have been kind of rising and falling with inflation. So first we got margin expansion because demand-driven inflation, and then margin-driven inflation. Then consumers pushed back on continued price rises, and margins fell. But following 5 quarters of steady decline, margins are stabilizing now. And the good news is that they are stabilizing at still very healthy levels. So U.S. margins are at the high end of the previous range. Sales and earnings surprise has also been positive, but it hasn't actually spurred price gains. What we've seen is more reaction to the macro, and that's because this positive surprise has been accompanied by negative guidance, in particular worry over weak consumer demand. And so again, it points to the macro being a large driver, regardless of what's happening with earnings.
Yeah, and in your actually data points, you say the U.S. earnings recession is over. Skylar, thank you so much. I'll have to come back because we have plenty more to talk about. Skylar Montgomery Koning, head of macro strategist at TS Lombard. Now, one other stock that we're watching out for is JD.com, rising some 5.6%. This comes as third quarter net revenue actually beat estimates. So we'll have a full roundup of the main stocks to watch next. This is Bloomberg. Now, Germany's top court has struck down a key element of the government's funding plans to address climate change and transform the economy. Well, Bloomberg's Oliver Crook joins us now with the very latest. Ollie, good morning. This feels significant because basically they took an issue with some of the money that was transferred for COVID and transferred into under funds. What does it mean going forward?
Exactly. We got to do a little bit of a history lesson here. So basically there was this money that was approved to use for COVID emergency spending. Some of that money was left over, 60 billion euros, which is not an insignificant sum. And that was transferred from the Schultz government from that emergency COVID fund, which was not used, into this climate transition fund. And basically that relied on the argument that this was going to help stimulate the economy and obviously help kind of the broader German economy, and therefore sort of worked under the umbrella of this emergency funding. And the CDU, the opposition, the conservatives, the fiscal hawks challenged us. They brought it to court. About a year ago, the court ruled in favor of the government, which is why this is such a surprise, with now the court finally ruling that this does not actually work, that the preliminary ruling did support the government. This does not. This is kind of an unexpected outcome. They are saying that the Supplementary Budget Act of 2021 does not meet the constitutional requirements for emergency borrowing, and that the law violates the budgetary measure and that it is incompatible and void. So this, in terms of the broader ramifications that this could have for Germany, this comes at a time when the coalition here is very, very, there's a lot of arguing within it. There is the AfD, the far right, that has risen precipitously. This is really a blow to the Schultz government. And it's just, and we expect to hear from them a little bit later today, probably from the Chancellery. But again, this is just primarily, we're going to have to go through some of the details of what this actually means, what happens to this money, but it's a real blow to the Schultz government, and that is certainly an indisputable takeaway from this.
Yeah, so, Ollie, what I'm trying to figure out is that does it actually mean that they need to spend less, or is it like a legal problem and how they went around it, or is it now the Constitutional Court saying actually we worry about the deficit, you can't spend this much?
Well, the question is, like, what happens to the 60 billion euros now, right? So this was sort of outside of the normal sort of budget because it was transferred from this emergency fund. And I think that this now hangs in the limbo, and we're still getting headlines because they're literally reading the verdict of this over the last few minutes. So there's going to be a bit of nitty-gritty, as you know is the case often with sort of German fiscal efforts. But I think that really the question is going to be what happens to the 60 billion euros. And again, the budget is back in focus, particularly in the wake of all these emergency actions that the government has taken over the last few years, from the pandemic to the emergency, of the energy crisis. All of these things are now coming to the fore.
Ollie, thank you so much. Oliver Crook there in Berlin with the very latest, of course, on the Constitutional Court in Germany. Now, coming up, we'll be speaking to Sandro Pierri, Chief Executive Officer at BNP Paribas Asset Management, about his outlook for the European economy. We'll talk markets. We'll talk, of course, some of the fees also surrounding the asset managers and some of the risks and rewards. That coming up shortly. This is Bloomberg. Investors welcome cooler than expected inflation readings in the US and the UK as evidence that central banks may be done with aggressive rate hikes. Stocks rise, the dollar and pound fall. Germany's top court has struck down a key element of the government's funding plans to address climate change and transform the economy, dealing Chancellor Olaf Scholz's coalition a major setback. Siemens Energy sees a return to profit in 2024 after a government intervention, but Alstom tumbles after the train maker said it's cutting jobs and selling assets to shore up its balance sheet. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. inflation broadly slowing in October, indicating that the Fed may finally be done with hiking rates. Markets now put the chance of another Fed hike at almost zero, while pricing in 50 basis points of cuts by July. Well, joining us now is Sandro Pierri, I'm going to say it the Italian way, Chief Executive Officer of BNP Paribas Asset Management. Sandro, as always, thank you for giving Bloomberg a little bit of time. I know you're very generous and you're trying to explain, first of all, the kind of markets that we have now and what we'll be left with. What's the question you get asked most day in, day out? Is it inflation and central banks?
Well, first of all, thanks for having me here. Look, we got asked many questions. I would say probably the most frequent one are inflation and unemployment. I mean, while I think inflation is slowly coming down, and I think the numbers yesterday is clearly confirming the thesis that inflation is a bit more under control. What is a bit striking is the resilience and the strength of labor market on both sides of the ocean, which is the other element that would give us comfort in believing that as we go in 2024, markets will buy more aggressively into basically reversal of central banks tightening. There's a number of structural reasons probably for labor market. To us, probably the best explanation is that given the shortage in labor market that many firms have seen after pandemic, they're very, very cautious in taking more radical action because they know that it's going to be very tough to rehire when the economy will restart. So unemployment, inflation, probably the most tricky question at this stage. And I think the rally yesterday is quite meaningful because I think it signals that there's appetite for risky assets the moment there's a clear outlook. Now, having said that, I think is definitely the numbers yesterday is a bit better. But our view is that central banks will err on the safe side, meaning that until they will have really significant confirmation that inflation is under control, they will not start easing. So it might take a bit longer than market is discounting right now.
I'm really happy you came in today because I feel like we have everything. So we have the U.S. inflation number in the U.S., the rally that you were talking about. We also have President Xi and Biden meeting. And it seems that markets have largely discounted or not really focused on geopolitics. Again, is there a worry that, markets are looking at the wrong things and that actually they don't even know how to price stagflation, which is what you're potentially hinting at if the labor market stays strong?
Now, look, it's a very difficult market to navigate cyclically, but I would say even more structurally. One of the theses we have been putting in the world with our clients is that we're living in a world of what we call four multiple transition. So everyone has been focusing really on the ecological transition and energy transition. But at the same time, we're seeing a technological transition, we're seeing a demographic transition, and we're seeing a geopolitical transition. And they're all happening at the same time, which is quite unprecedented. Like in my professional career, this is the first time that such a big change is happening. And it's structural in nature. These four major forces are self-reinforcing in a way, but potentially also contradicting each other. And there's a couple of implications for that. I think longer term, and that's where the market is struggling to price properly, is we believe that this is pointing to structurally lower GDP growth globally and higher inflation. And this is almost like a paradigm shift compared to the last 20, 25 years. So in a way, we are in a regime change, which is very difficult for market to price because we normally look at what has happened in the past. So that's exactly where we are right now.
And I guess underpinning everything is the cost of money, right? The cost of credit. And again, how much of that is structural given the shifts, the four shifts that you were talking about it?
Well, look, if we're right in saying that inflation will be structurally higher, like not dramatically higher, but probably averaging the 3%, of course, the floor in interest rates will be significantly higher than the one that we have seen in the previous cycle. So the zero interest rate, probably we're not going to see it for quite some time. So there's a structural element also in interest rates. And by the way, slightly higher interest rates are not bad necessarily. What I think has really hurt the economy, the system, is the speed at which rates have risen over the last 2.5 years. Not necessarily the absolute level, but the speed has been really significant.
Sandro, we also had the governor of Banco de Portugal a short while ago here, and this is what he had to say on European growth.
Are data dependent, and these data really are good. They show that inflation globally is falling. The same thing is true for the Eurozone. We got a number for October that is already below 3%. We must be patient, but yes, we have this feeling that we are doing our job.
I mean, he was talking about anxiety, right, over a soft landing. What kind of questions do your clients want from you? Does it feel good actually being in charge of an asset manager right now, or is it getting a crowded space?
Look, as a business, I think we're also going through significant transition. I mean, it's been a great business to be in over the last 20 years, top-line growth, margin expansion, and driven by structural forces. I mean, the reality is that today, even in Europe, only 1/3 of households have their assets and savings professionally managed, and this will continue. So I think we continue to be in a growth mode, but the other driver for us has been market performance, because our asset base goes up and down with market, and structurally over the last 15 years we've seen assets going down because of market performance. I think the next year will be a bit more challenging because probably we have a view that actually expected equity return will be subdued somewhat relative to what we have seen in the past. And that will have an impact on the structure of our industry. And everyone is discussing about, pressures on cost. We'll have pressures on the top line as well. So it's a bit of a reversal of the previous long cycle that we've seen in asset management. But I think it's crucially important that we reestablish our role also from a policy-making perspective. We're a key mechanism in reallocating capital. And I think one of the structural debate that we're having with policymaker and regulator is how we can support, on one side, this big transition that I've just made reference to, and make sure that we support the reallocation of capital for energy transition, for example. So I think we're playing an important role. I think it needs to come with an increased retail participation in capital markets, which is something that I think we started to see happening, but it's still too low.
But given where we are now, and I'm not speaking about BNP Paribas Asset Management in general, do you think that the flow of capital is going to where it should be, given the shift also for the green transition, or is there still a lot of work to be done?
Look, it started to go in the direction that policymakers has identified. I think if we look at the flows in the sustainable related product, Article 8, 9, I don't want to go too much into the technicalities. Over the last 2.5, 3 years, we definitely have seen this product attracting more flows than all other products. So this is happening. I think also the tilt that we're seeing on sustainability on the private asset side is clearly going in the right direction. Now, having said that, the challenges for supporting the net zero transition is just huge. I mean, it's an additional $3.5 trillion per year to support net zero transition. And so it's not enough. I mean, we're just at the beginning. And of course, there's an element of expected return. We have seen a bit of pressures over the last few months on performance of products which are a bit more sustainable. Look, this is a cyclical business, so we'll see it more and more going in waves. But we're just at the beginning, and I think we need to accelerate, because the reality is that the pace at which, especially in Europe, we have deployed renewable sources is not enough to be consistent with a 1.5 degree pathways. So we need to accelerate now.
Sandro, thank you so much. Don't go anywhere, because we'll continue the conversation. Sandro Pierri, the Chief Executive Officer of BNP Paribas Asset Management, stays with us. This is Bloomberg. Welcome back. Now, we are just getting some breaking news on the Bloomberg terminal. This is the EU taking aim at some of the key machine exports to Russia in some new sanctions. So this is, for the moment, a proposed ban on the export of machine tools and machinery parts that Russia uses to make weapons targeting Ukraine. Now, this is according to EU documents that Bloomberg have seen. I imagine that the main focus on the new sanctions package is actually to try and further crack down on the Kremlin's ability to circumvent EU sanctions and feed its war machine. Now, yesterday, we also had a very robust conversation with Torre Bolzoni of the IEA. And when you look also at oil outflows, in many cases, it feels like Russia has been able, if not circumventing some of the sanctions, certainly they haven't been hit by the oil sanctions as much as the West would have thought it will. So we'll see exactly where this ends. I imagine also by taking aim at some of these machine exports to Russia, it could actually curtail Moscow's source of revenue. So we'll keep an eye on this to give you any more breaking news on that. Maybe also look at some of the companies that are doing some of these machineries. But let's go back to talk about asset management, fees, some of the challenges going forward and some of the main opportunities. I'm delighted to still be joined by Sandro Pierri, the Chief Executive Officer at BNP Paribas Asset Management. Sandro, thank you for joining us. We were talking a bit about markets, client behavior. We were talking about the reality of stagflation. And you very clearly and beautifully put the fact that we're going through a massive transition, that there are 4 parts of the transition, and we don't exactly know where we end up. What does that mean for asset managers? Well,
for our industry, again, we will have to cope with possibly lower growth and probably subdued equity returns, which clearly is an important determinant of our revenue growth. On the flip side, we'll definitely going to see a revival of fixed income. I mean, with rates, long rates and short rates being that high on both sides of the ocean, I think that creates clearly opportunities. And I think we start to see money flowing into fixed income product from probably September onwards. And, the value proposition is reasonably simple. You might lock in for 5-10 years, anywhere between 4.5% to 5%, which actually is a great stabilizer of your portfolio return. Sandro, is the 60-40 portfolio dead? I've been asking this for the last. I feel like definitely last year was dead. Definitely last year was dead, and clearly, I mean, we have done a lot of research like everyone else. It shows that actually the benefit of diversification of bonds was no longer there because bonds moved. They were completely correlated with equities, which is normally doesn't happen, and that's the reason of the diversification of portfolio. Now, probably the way the 60-40 portfolio has been thought through over the last decade is over, but the need of having a diversified approach to your investment is key. And I think what has changed compared to last year is that the base rate, the base level of yield is clearly higher. So your starting point is 4.5%. You have a carry that will be used as a buffer to offsetting the volatility in bond prices. So I think our view at this stage is that bond will definitely provide, again, diversification and protection in an environment which is going to be very volatile.
I mean, you're the chief executive of a very sizable asset manager. What does AI mean for how you service your clients? Is it something that you spend a lot of time on, or do you spend more time really trying to figure out where capital flow goes to in the transition?
No, we spend time on everything that we think is going to be strategically significant. But I would say that AI, I think, is very early days, not only in our industry, although we start to see some meaningful impact. But I think where we're focusing right now on AI, in everything that is has a potential to generate efficiency and automation. There's, the number of use cases that the team has brought up is just huge, and we need to prioritize, we need to test. And there's another element which is important. Everyone is talking about AI. The reality is that if you don't have your data set in orders, there's not a lot that you can do with AI, because it's about accessing data. And there's probably a bit of catch-up that needs to be done there. So we're looking at it. We are starting to frame our journey towards using increasingly AI. But at the same time, I mean, what keeps us busy now is trying to understand whether we have the right product offer for a cycle which is going to be very different in a way.
Talk to me about, I mean, asset management is a crowded space. How do European asset managers compare with US ones or Asian ones? The brands feel very strong. Do you get that? Does it translate into revenue?
Look, overall, I would say the European asset managers are doing quite well. I think they've benefited from the brand of UCITS, which is the vehicle that has proven to be a pretty effective vehicle to protect investors and with a very good regulatory framework. And I think UCITS is now being recognized as a brand not only in Europe but also outside Europe. There's a difference, which is a structural difference between US and Europe from an asset management perspective. The first one is that US asset manager, their home market is the largest market in the world and is one single market. For European asset manager, even if European Union Capital Market Union, but doing business in different countries is not exactly the same thing. So the level of economies of scale is completely different. And the second major difference is that U.S. asset management industry has grown because of a significant tax incentive when it comes to long-term savings, the 401k plan, which I think is still missing in Europe. So structurally, these are, I would say, the two main differences. But the human capital in Europe is now absolutely great, and I think we feel we can absolutely compete with some of the largest players, and we'll see growth.
So interesting. Sandro, thank you so much for joining us today. Sandro Pierri, BNP Paribas Asset Management Chief Executive Officer. Now, European Central Bank Governing Council member Mario Centeno also says there are concerns over the euro area economy, whether it will have a soft landing following a lack of growth in recent quarters. Well, Centeno spoke exclusively to Tom and Anna.
The numbers have not been great. 0, 0.1, minus 0.1 quarter on quarter for 5 quarters in a row creates a little bit of anxiety over will this be a soft landing? This stagnation of the euro area is, of course, a source of concern for all. It will help bringing inflation down, that's for sure. And of course, monetary policy sometimes also has this side effect, which is the main channel, actually, of our transmission to the economy of our decisions. We just need to follow on the data. Again, the labor market is the pillar. It works pretty much as a dam to protect workers, firms. But it is a derived demand. It is the result of the economy, so we need to follow it very closely.
On the emergency program, the PEP program, so the Pandemic Emergency Purchase Program, and the reinvestments. So the ECB has signalled that reinvestment will continue until the end of 2024. Is that time frame still appropriate?
One of the greatest successes of this cycle of monetary policy hiking in the Eurozone this time was our ability to keep financial stability, which is a precondition to price stability. It didn't happen in the previous hiking experiences, but this time we've been quite successful. So anything that we do that is not focused entirely on price stability, keeping financial stability will not be on our menu, but we need to reduce the balance sheet. We know that, and we will do it, but always having in mind this prerequisite of keeping financial stability.
Well, European Central Bank Governing Council member and Portugal's Central Bank Governor Mario Centeno there. Coming up, President Biden is sent to meet China's President Xi Jinping in San Francisco. So we'll look at the challenges facing both leaders. That's next, and this is a Bloomberg. Now, the Chinese President Xi Jinping has arrived in San Francisco for a high-stakes meeting with his American counterpart, President Biden. Their talks on the sideline of the Asia-Pacific Economic Cooperation Summit comes as China seeks to boost confidence in its slowing economy. Now, here for more is Bloomberg's EMEA news director, Ross Matheson. Ross, I think they're also gathering among like 16 acres of lush autumnal garden. So maybe they'll go quietly at the back to try and find a deal like what we've heard whispered of former presidents. Yesterday, we were talking about what they each need from each other, but what's considered a success, actually?
Well, beyond the meeting itself, which, of course, is a reset after they met about a year ago in Bali for 3 hours, and we seem to be on the runway for that breakthrough, and then, of course, it went downhill for a while. So we're back there at that point, right? So they have a meeting in San Francisco late today. It could go for several hours. It's a bit of a reset again, a bit of clearing of the air, mutual interests on either side for that. But then what happens after that? The expectation is we'll get announcements about continued lines of communication, and we're going to have this group that will be talking about things like military affairs going forward. These group of officials will be talking about things like AI and so on. So there'll be announcements about a whole series of of lines of communication that will remain open after this conversation. That will be the most immediate, tangible that will come from today.
But overall, is this about the economy or is this about the military?
It's really about interests for both. It is for Xi Jinping about the economy. As you were saying, his economy is struggling and he needs to get it back on a better footing. He needs markets to settle down. There's a lot of imagery already. So he's turning up with a bunch of Chinese journalists with every move, a big crowd at the airport last night. So that's all beaming back into China, showing him doing what's needed to portray China's interests on the global stage and to help the economy. So that's good for him. I mean, that's really the impetus. And, of course, for Joe Biden also, he has economic imperatives. We've got China buying soybeans again. We've got China perhaps welcoming US business back in. That's all good news for Joe Biden. So right now we've got a win-win in a way of interest for both of them. The question is, how long can it last? Yeah,
and back home, do they both need to be quite tough on the other one, actually, for appearances?
Well, that's, again, how it's all portrayed. For Joe Biden, he does have a need to have a thaw with Xi Jinping for now, but he's coming into an election late next year, and he can't do things. It's quite difficult, for example, to dismantle all the architecture around tariffs that were put on China, because he does still need to be seen to be protecting US business, supporting US business. So there's only so far he can go, and he's taken quite a tough stance on China so far. The mood in Washington generally, politically, is to harden on China. So he doesn't have that much manoeuvring room. So for him, it's about messaging at home. For Xi Jinping, it's about showing up, showing he's very present on the global stage, is being received by the US president very much as an equal leader, as an equal partner in global affairs. But again, it'll be about the way that message reflects back home.
Ross, thank you so much. As always, Ross and Matheson there on the latest with that President Xi and President Biden meeting. Now, coming up on Bloomberg Surveillance, we'll also be speaking to the EU Economy Commissioner, Paolo Gentiloni, 12:40 UK time.